Sir Isaac Newton is widely regarded as a clever man. He invented calculus at the age of 24. He also asked very prudent scientific questions like, if an apple falls, does the moon also fall? But he also made some pretty terrible decisions. He was an alchemist and spent a lot of his life trying to convert base metals into gold, and as a result of that started drinking mercury before dying after a slow descent into madness. But arguably a worse decision he made is with his investments. In the early 18th century, he lost most of his wealth because of this investment strategy, and it's still a strategy used very commonly today because it sounds good, but beware. So before we explain what you shouldn't do, a couple of housekeeping points as to what you should do. Before the arrival of modern portfolio theory in the 1950s under Harry Markowitz, it was quite common for investors to plough all of their money into single stocks. That quite often led to wealthy landowners coming back to their wives and saying, "Sorry, I lost all the money in that US railway company." Since modern portfolio theory, it's much more typical to diversify your wealth over a wide number of assets. That means you can minimise the impact of any one company going bust. You can't mitigate against the overall systemic movements of the market, but you can prevent the risk of total capital loss because of a single company. Now, the second thing to note is that there is a relationship between risk and reward. Those who want better returns will invest in equities, typically, shares in companies, whereas cautious portfolios will invest more in the likes of treasuries and bonds and gilts in the UK. And you'll also have some things like commodities or real estate for diversification purposes. So managing your risk against how you can tolerate it yourself is very important, as is diversification. So, Isaac Newton, what he did is to look at the market and say, okay, the market's volatile, it's going up and down. What if I were to sell out while the market's high and then wait till the market falls to its trough and then buy back in at a lower price, so then when it rises again, I get the resurgence and I've missed the fall? The only problem with that theory is that Newton wasn't an omniscient deity. And what actually happened, in this case it was the South Sea stock, he sold out and the market kept going up, and eventually he bought back in and then the market fell. And what this highlights is that it's very difficult to time the market. As the old adage goes, time in the market, not timing the market. And for Newton, he lost about £20,000, which in today's money is just over £3 million, and he was broke after that. As was the case for Newton, a huge risk to investors is behavioural. They make emotional decisions because they're jittery about the ups and downs of the market. The problem is that 80% of the best days are actually in a bear market when the market's coming down, or in the start of the bull market. And the investors that move in and out of the market also pay higher transactional costs. But to put this into perspective, if you had a typical portfolio, which is 60% shares and 40% bonds, invested from 1996 to 2024, if that portfolio missed the 25 best days, it would have reduced its return by 60%. So the data shows that not only do these investors pay more costs incidentally for moving in and out of the market, they actually face lower returns. So my message to you is, don't be like Newton. Don't try to time the market. Stay in the market and get all of the highs and the lows, because that's the only way you're going to secure all of the peaks and not miss the best days.